You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, markets are looking pretty good recently. It's been a long time since we've said that. We've had some good news on the COVID front. Many companies have came out with potential vaccines. We have the Russell 2000 index leading the way, basically beating up on all the large caps overall and setting new highs. The Russell 2000 recently hit a new high, and that's overall pretty good for the markets. So what has happened with the VIX? Obviously, I think the biggest thing that was holding up the VIX, first of all, was the election. And we did see the VIX run up pretty high going into the election, up around the 37% level just the night before the election. And then the VIX did come off and it's came down and it hung around 25%. But now that we've had the news about the vaccine, I personally am kind of surprised that it has still stayed around that 25 to 20% level. And for the first time since before the March turndown, the last time that we actually got to the 20% level, or just about to that level, was January 30th of this year. And this week, we actually saw the VIX touch that level. So interesting enough, it is coming down, but it's doing it trepidatiously, if you will, in that we are setting new highs in a lot of stocks and a lot of indexes overall, but there's still a little bit of fear that is out there in the marketplace. And until we really see some movement in the distribution of the vaccines and people actually taking it and things actually happening in that front, I still think that the VIX is going to stay fairly high relative to what it actually really should be when you're setting new highs in the marketplace overall. So that little segment right there is going to lead us into our trade this week, which is going to be a backspread in the VIX option contracts. We're going to do a backspread using puts. So we'll talk through that. But I just wanted to mention last week's trade that we looked at. Once again, everything's meant to be a paper trade. We're just learning here on Options Playbook Radio. And if last week we just talked about buying in the money options on lower price exchange traded funds as a way to just not miss out. If you still have some fears in the marketplace, there's still a lot of unknowns going on. How could I allocate some capital without buying all these stocks outright. So I'm limiting my downside risk. And that's what we did in Jets. So last week, Jets closed at Jets was an airline stock, ETF, I should say. I should give you a little bit of an explanation. Symbol is JETS, and it's an ETF that only has airline stocks in it. And that was trading at 1976. We looked at buying an in-the-money leap option, talked about maybe selling a call against it, which would make it a fig leaf inside the playbook. That's the name that we call that strategy. Some people will call it a leverage covered call. And now the stock is at 22.73. It was up about 1.3% today. And we are taping Options Playbook Radio on the 2nd of December, and the markets are closed. So this would just be stay the course. This is exactly what you're looking for. A little bit of a move to the upside, allowed you to participate in it. You didn't have to put all the money out to buy 100 shares of stock. We just are renting the stock, if you will, and bought in deep in the money leap option. Now, I also mentioned last week that what are some of the other industries that haven't made their ways all the way back from the March downturn. And, we talked a little bit on one of the shows at Ally Invest about the financials. The financial stocks that still are not back to where they were before the March downturn. So maybe look for some of those sectors, and this could be a way that you can participate using ETF options on very liquid underlyings. That's the biggest thing about going deep into money, or going deep into money and further out in time, is that a lot of times that options marketplace gets wide bid-ask spreads. It's a little bit illiquid. And if you're doing it on underlyings that aren't very liquid, that don't get traded heavily overall, sometimes that strategy is hard to implement just because you're paying so much to get in and out of the position. But Jets has very good long-term option bid-ask spreads, liquidity, if you will. And also the XLF is another one. And just think of any other industries that you might want to think about if you want to just slowly allocate some money back into the marketplace without going all in by buying just stocks outright overall. Okay, so that was short and sweet. Let's get into this week's trade. So we're looking at the VIX index, and one of the biggest things to always understand with the VIX, and I don't ever want to take it for granted, is that if you trade the VIX options, you are not trading the actual VIX index, which would be considered in the futures world, we would call that the spot. The VIX today closed at 2117. It was up 40 cents on the day. But we're going to go out until January. We're going to hope that the trends of this marketplace, the good news that we had in November, continues on into the new year, and we see some of that fear, and i.e. volatility, come out of the VIX index. So how can we do that? Well, we're going to go to the January expiration. And if I look at the January futures contract, that actually is trading at 24.33. So it's still above where the VIX is at today. And even the December contract, it's at 22.68. If we look at the February contract that goes out beyond January, we're seeing that at 24.83. So it's a little bit counterintuitive in that you would go out further in time and the marketplace is still expecting higher volatility. So our outlook is going to be that there's going to be less volatility, or I should say that the index overall doesn't necessarily mean that the market will slow down, but the index overall will come back down to a more quote unquote normal range. It will revert to the mean, and that's usually what the VIX does. It hasn't done that recently, like over the last couple of months, where it's just stayed right at that 25% level. We're finally seeing the spot. We're finally seeing that index come down. I think it was a good sign that it got down to the 20% level. And I think it would be a good sign overall for the markets if the volatility index would actually breach that 20 level and get back to a little bit more normal volatility range, or at least in that range prior to the big downturn from the news from the pandemic. So if you're trading VIX options, that's rule number one, is that you have to realize what is your underlying, and your underlying is the futures contract with that same expiration date as the options. So we're going to use that January expiration date. And the second thing to understand when you're trading VIX options is that you are actually trading the volatility component of the option contracts as much as you are trading the movement of the actual VIX index. So if I look at this and I look at the VVIX, is the VIX of the VIX. It actually tells us the implied volatility of the option contracts on a 30-day basis for those VIX options. So obviously, that volatility number is going to be much higher than the VIX. And right now, that's trading at about 107. And that has dropped precipitously since the election. Prior to the election early November, it was as high as 150. It actually even breached the 150 level, and then it's now down to 107. So you think about that on a 30-day basis. If you buy that at the money option contract, in theory, you would be paying 107% implied volatility. So that's just a scary thought overall. So very rarely do, especially retail clients, just buy puts and buy calls in the VIX outright because they're so juiced up. You almost always have to sell something. So a benefit of that juice is that you can get creative. And I think one of the more creative ways to trade this underlying is to look at back ratios. This means that we're going to sell one option contract and buy two option contracts in anticipation that the market is actually going to go down by that January expiration date. So this is a backspread, and here's how it works. Remember, the VIX in January is trading around the 24% level. Okay, that's basically where that index is at. And we're going to go down a little bit. We're going to sell one 21 strike put and then buy two 19 strike puts. Now, the whole goal of a backspread most of the time is that you sell the more expensive option and you bring in enough credit to pay for two of the less expensive option contracts. So the option contracts that are further out of the money. And we can do this as of right now, as of this taping. Like I said, it's December 2nd. The markets are closed. The VIX is at 21.17, but the futures is right around 24. If we did this trade, we could get it done for a net credit of 15 cents to the account. And if I'm doing a trade in the VIX and I'm doing a backspread like this, I'm not going to do it unless I can get it done for a net credit, because I really don't know where it's going to go. And if I'm completely wrong on my forecast and the VIX stays at 24, well, by that expiration date, if it's 21, the put that we sold or higher, then we get that 15 cents. And, it basically covers commissions on your trade overall, but it's something. And it's nice to do a trade every once in a while where you can be dead wrong about your forecast and still be profitable on your trade. And this backspread allows it. And the main reason why we can do this and get it done for a net credit is because there's so much volatility in the options that are traded based off of the actual VIX, that's the symbol index. All right. So I feel like I should summarize the trade again. We're going out to the January 20th expiration. We're going to sell one of the 21 strike puts, and the same expiration, we're going to buy two of the 19 strike puts. And we're going to get this done hopefully at the midpoint right now, which is a net credit of 15 cents to the account. Okay. So by doing this, I do have additional risk. I've sold the 21 strike put and I bought two of the 19s. That means that there's really a credit spread that's embedded inside this strategy. And another way to think about this, and some people will call this a pay later put. That's actually another name that has been used. You can actually see it inside the options playbook if you look up the strategy and the AKAs. And it kind of makes sense because what you're really doing is you're selling one put credit spread to pay for an additional put. That's really what you're doing. You're selling a put credit spread to pay for an additional put, and hopes that the market will go down immensely because I'm long one more put than I'm short. So I have a $2 margin requirement from that short spread from 21 to 19. So if I put this trade on, I bring in a net credit of 15 cents to the account, but my margin requirement on the account is going to be $2, or for every 1/2 spread that I put on, $200. Now, that's also my max risk. And the maximum that this could trade for is $2. But remember, I brought in a 15-cent credit. So my max loss on this trade is $1.85, or $185 for every 1/2 spread that I do. But with that said, it's very hard to lose the maximum. What would have to happen? The market would have to come down, stop right at 19, and stop there right at the expiration date. If that happens, well, then I could lose that $2. So it would have to be exactly at 19, exactly at the strike that we bought. If not, if it's anywhere in between, well, then I'm going to be a little bit profitable. And if it comes down to 19 sooner rather than later, I could even be profitable before that expiration date. And that's ideally what we're looking for. We would hope, even though if we go out to January, the January 20th, 2021 expiration, they've got 49 days remaining, but we would like to have this happen within the next 30 days. If I get down to the final 2 weeks and we just haven't really got a move or anything hasn't really happened, I might just get out of the trade. I just don't want that risk of it landing somewhere around 19. So if I'm anywhere close to that, close to expiration, just close the trade and go on. Okay. So how do you manage your risk on this? Well, I think if I'm putting this trade on, it's really more of an all or nothing type trade. If I'm managing risk, I'm managing it by looking at what is happening with the expiration date and what is happening with implied volatility. Now, ideally, if we put this on, we would want the VVIX to go up. That would be good for us. But the only way the VVIX is really going to shoot up is if you actually see the VIX go up. So overall, that's not a good thing. It wouldn't hurt us. We could make our 15 cents. But ideally, you'd want implied volatilities to at least stay the same on the options of the VIX, or actually increase. Now, if the market does come down, if the VIX index comes down, now really, usually when the S&P 500 index goes up, the VIX goes down, right? That's been put to the test recently, but that's the normal, with air quotes, normally what would happen here. But if it does go down below 19, you're long one more put. So if you could get it all the way down to 10, which would be a very low VIX in this type of environment, but it's feasible, well, then this trade would do really well. You would profit on that one extra put all the way down to that 10% VIX level. You'd have to pay for that short spread, but that's all right. If it goes all the way down to 10, I'd have at least $9 of intrinsic value in that one extra put that I had. Okay. So if I put this on, though, I'm not looking for the home run. You're doing this trade. You're hoping that the VIX starts coming down and that it comes down sooner rather than later. And if I can put this on for a net credit of 15 cents, it's very possible that I could close this trade for a credit of $1 or $2. And if I executed this trade at a net credit of 15 cents, what I would probably do is turn around and actually put in a sell order to say that if I can get out of this trade at, you pick your price, let's say $2. I think that would be, I received a net credit of 15 cents. I have a maximum risk of $2. So if I could get out for $2, I'd probably do that. And I would just put that in as a good till canceled order. And then I would trade, then I'd set an alert from 30 days from now. If you want, you don't even have to look at it and say, well, where's the VIX at 30 days from now? And then come back. And if it's hanging anywhere around that 19 level, right where our maximum risk is at, well, then you just close the trade and get out. So quite simple. So interesting trade, but you have to understand the VIX. If you do not understand what I explained, that the futures drive the January 20th expiration VIX option prices. If you do not understand that concept, you do not want to be trading in the VIX. And as always, this is meant to be a paper trade here on Options Playbook Radio, but this is a fun paper trade to look at, kind of like the doppelganger that we looked at a few weeks ago in some of the pharmaceutical companies. So they're just kind of fun. Keep an eye on it. You'd learn a lot about option pricing by looking at VIX options overall. And that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. Very simple handle. It's at Brian Overby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.